Hi, so I want to cover the most popular UK stocks and how they look, what the health of them looks like. So what I've got up here is the FTSE 350, that's the 350 largest UK companies, and I've ranked them according to certain criteria that I consider important. Their valuation, their revenue growth, earnings growth, their valuation as measured by their book value and their profitability, their performance over the last 6 months, their volatility, and their average returns, their cash flow, and there's a whole bunch of other things and things which I've not shown on here because it would just drag on too long and be too complicated. So of these, you can see which are my 9s, 8s, and 7s, but even amongst those, I want to distill down and have a look at their cash flows and sortinos and drill down even further. Now, what I'm going to do is, rather than just go through all of these, I'm going to name some of the ones which are very popular amongst people and analyze those for you. So I happen to know Lloyds Bank is very popular amongst private investors. So is IAG, International Consolidated Airlines, Rolls-Royce, BP, and Scottish Mortgage Investment Trust. Let's just go through those. Let's start off with Lloyds, okay? Let's put in Lloyds Banking Group. The main problem I have with people holding this is in terms of valuation. It's overvalued, the growth rate isn't there, the performance hasn't been too bad, it's bumped off the bottom, but you're taking a lot of risk. You are being a true speculator. In terms of volatility, over 20%, that to me is a bit risky, and in terms of the average return you get, the Sortino shows that for the volatility and the risk you're taking, the return isn't there. Forget cash flow, okay? But if I was to jump into this and you say to me, well, actually, Alpesh, actually show us it as a chart, okay, on that one, then this is what would happen. You would get this, and that's Lloyds Banking Group. And as I said before, yeah, it can jump off a bottom, and you're taking a lot more risk. And now you might say, well, no, I'm willing to speculate and gamble that it's going to go from where it is, which is at multi-year lows, as I've said in the past, and it might even double or go back to where it was, which would see it double. That is true. It may well do that. It may well, within this year alone, double. But just so you know the other risks to be taken on board of that in terms of cash flow, growth, valuation, and earnings. I personally, whilst there is that 100% upside, don't like to gamble and speculate, so it's too much risk for me. IAG is another popular one amongst private investors. Why? Because they're doing the same thing. They know it's been beaten back, so their investment strategy is, oh, it's been beaten back loads, I'll get into it. Look at the volatility, 33%. That's a very risky stock. It's Sortino. In other words, the return you're getting for that level of volatility does not make rational sense to have it. 8% return over 6 months, obviously better than a bank account, but that's not the criteria to judge it on. Valuation, growth, income, all of those things make it too risky. However, your rationale will be, I am sure, Alpesh, it's dropped so much from 400, it's gone to 150. Surely if it goes back to the levels it was at before with the virus and everything else in place, I'll double my money. You're absolutely right. Mathematically, that is what would happen. For me, if you put a gun to my head and said, no, I force you to give me a strategy on this, okay, I'll give you a strategy on it, which is, if it doubles up, get the hell out of there, count yourself lucky, but do not be surprised if it gets stuck at these levels for a prolonged period of time, okay? So I want you to be cautious. Rolls-Royce, another one. Of course, the reason you're all buying it as private investors is you're saying to yourselves, engines for airplanes, it'll all come back. People will start buying their posho cars, but it's really engines that they make their money from. Value growth, not justified. Yes, 13% return, which is why it's creating a buzz and people are buying it. Sortino, at least it's positive. In other words, the average return for the 51% volatility. Are you kidding me? Got some cash flow. It's not one of the best in terms of cash flow, but it's not too bad in terms of cash flow. Solid company. Yeah, I mean, again, you're speculating, but you might say, Alpesh, you're going to put a gun to your head. It's at about 100-ish. Well, again, I would say to you, look, if you double your money, get the hell out of there. You might do that in a year. It might do it a lot sooner, by the way, but I'm trying to be really cautious. And this is speculating because, given the fundamentals, well, what if it just stayed at this level for another 12 months? It may well do that. So it's certainly not get rich quick. It is in the speculating gambling camp. And you might say, you're being too cautious, Alpesh. Come on, look at where it's historically been, going back for the last 25 years, and look at where it can be. And you'll double your money if that happens. Well, I understand the rationale. I'm not stopping you, but I'm saying, yes, that is a strategy. Just be aware of the risks you're taking if you do that. Let's look at BP, another popular one amongst you private investors for exactly that reason, okay, of the same beaten down. Value, growth, income, worrying. It's actually down 17% in the last 6 months, which to many of you make it more attractive. Volatility, very high. relative to the return. In other words, although its absolute volatility is only 15%, the return is negative, so the Sortino drops below. Cash flow, small. Companies with less cash flow, and that's to do with the oil price, tend to suffer more. Now, if you, again, put a gun to my head and said, no, I want you to create a strategy for me. I've discussed this before on the BBC. I've discussed it in multiple areas. And I said, yes, you're absolutely right. It is at a 25-year low. And because it's at a 25-year low, were it to go back from its current levels of, say, 250 to 500, which is a reasonable average it's had over the last 10 years, you double your money. You might do that this year even. And it's a big brand name, and so you feel confident and safe. Like I said, there is a fundamental risk on the valuation, the growth, the income, the cash flow. However, I understand the strategy that, yes, double, but don't get greedy once you've doubled into it. And the journey won't be just V-shaped in any of the ones I've already mentioned, I'm afraid, okay? It will always be up and down and sideways and all the rest of it. So that's a quick analysis of the most popular stocks. Like I said, none of them sort of went right at the top in terms of the other factors. I wouldn't just pick, of course, I'm not going to just pick Imperial Brands because it's a value growth 9. I still need to look at the Sortino, the cash flow, the performance, a whole load of things, but we'll come to that in future videos. Hit like and subscribe and all the other things that people tend to do nowadays.